Hello, welcome to my live stream. This is a live stream on a Saturday to talk about stocks, to talk about the stock market, to talk about how we can value companies, to find the best companies that we can invest in to grow our wealth, to take an investment and grow it over time. I'm Victor, and I am a fundamental stock investor. I like investing long term. I like to find businesses that are discounted. Either the market doesn't understand them, doesn't believe in them, but I do. And I stand corrected over time when I make an investment and make a lot of money. Some occasions I am wrong, but most of the time I get it right. And that's what makes the difference. That's what's enabled me to have a really good year this year. I have a channel and invite you to be a member of the community. There's 4 levels. And when you come on the live streams, if you're a member, you can ask for a stock to be reviewed, and I can review that stock. We'll go over it, see if it looks good fundamentally, see what the business is about. Is the business in a good, attractive business, or is it not? Is it a business that maybe is overpriced, or maybe may not have a really valuable future? That's what I try to figure out. There's a variety of businesses that we can invest in, a variety of industries. Some industries provide really good profits, some don't. And it's good to know which one are we investing in. Are we investing in an industry that has just terrific ability to generate profits, cash flow, cash on that balance sheet? Or are we maybe operating with a business that hasn't been or isn't all that great? So that's the difference. Looks like Herdo's on. Hey man, thanks for the positive feedback. I'm glad you like the videos I've been creating. I've been putting more effort to make videos just interesting and maybe covering industries. And I'm in the middle of looking at making a video on the best growth stocks for 2026. And you'll be seeing that Herdo probably late tonight. I've already finished the filming part of it. Now I need to edit it and I'll put it out there. So looks like Mark, and Mark, I think I owe you an apology. I finished the stream yesterday and I saw that you wanted me to look at some stocks, but I didn't see your note late in the stream. So I apologize for that. And I think you wanted to look at HIMS and other stocks. And I'd be happy to do that if you want to bring up the 2 stocks you wanted me to look at. So I hope you're having a nice weekend, Mark. And thanks for tuning in. All right. So the market had an interesting end of the week for sure, where we had the market go up a little bit after having a sell-off. If we look at the 5-day, we're almost back to even. Friday, December 12th, we had a pretty good sell-off, but just the 5 days this past week, we're close to even. So overall, I would say we're still down about 1%. And I think we're going to continue to rally higher because we tend to have rallies at the end of the year, the Santa Claus rally. I think there was some selling, some profit taking, maybe even some loss harvesting, where investors will harvest their losses to take advantage of the tax code. So that's probably kind of through the system, so to speak. We're probably going to see stocks rise. That's my expectation. It could be different. Just most of the time we rally into the end of the year. The market was going through a rotation. If you think about, let's look at the 1 month heat map. And this doesn't quite show what I thought it was going to show. Let's look at the 3 month. Yeah, that doesn't either. But there was kind of a rotation going from semiconductor into other spaces. And you see it over the 3 month. Meta's had a sell off. And that didn't quite continue, obviously, because now things are kind of mixed up. Broadcom had some big negative days, but it's kind of getting back on its feet. Micron had a terrific week, up 10%. And that's with a couple bad days at the beginning of that week. So It's a market where semiconductor caught a really nice bid. And really, the question that if you have a sense of what's going to happen here, and it may be a thing to just be aware of, is semiconductor is going to continue to do well so long as the build out of data centers for AI continues to have the investment. If companies like AWS and Microsoft and Google Alphabet with their Google Cloud business and other companies, if they continue to buy up semiconductors from NVIDIA and putting them in their data centers, for 2026, the semiconductor trade is still going to work. But if we see a slowdown, a pullback on spend, it could be a pretty ugly situation for semiconductor. As we look at the earnings that are going to come out, and not necessarily the earnings of NVIDIA or Broadcom or Micron, I would say the earnings of Google, Microsoft, AWS, Meta, and listen to what they're going to do with capital expense. And if they communicate that, hey, we're going to slow down our spend, that spells trouble for semiconductor and it will sell off. It'll be very easy to notice. But I think that investing in semiconductor, you have to have your running shoes on, because if you see a sell off, it's going to be important to run out, is my opinion. We'll see. If it continues to work for the rest of the year, great. If we have earnings from, the big consumers of semiconductors and they continue to say, no, we're going to keep buying, great. It should continue to work through 2026. But I'm trying to find places and investments that maybe are just a little clearer. There's better valuations and it's a good time to invest. We're going to look at HIMS versus ODD. Glad to do that, Mark. We will take a look at that. I know I have HIMS in my valuations. ODD, we will look in a few minutes. All right, so that's where the heat map's at. Now let's take a look at, let's just go ahead and jump into HIMS. And we're going to compare HIMS versus ODD. Oddity. And oddity, let me study this business because I've come across it before, but I'm not quite certain I know what they do. I know what HIMS does, but let's take a look here. Oddity Tech operates as a consumer tech company that builds digital-first brands for the beauty and wellness industries in the United States and internationally. It serves consumers through its AI-driven online platform, which uses data science, machine learning, computer vision capabilities to identify consumer needs and develop solutions in the form of beauty, wellness, and technology products. Okay. So it looks like the company provides a portfolio of products, including face and complexion, eye, brow, lip products, makeup tools. Okay. So they're providing makeup tools and so forth for people. Great. HIMS is, I would say, more of a health-oriented company they really focus on categories that have a lot of demand: weight loss, hair loss. They have sexual health and other areas that they believe that's what a lot of people need. So they have been a good growth stock. It's $8.1 billion market cap company. It has a forward P of 60. Again, it's a growth stock. So let's wait to see their growth before I call out that it looks like an expensive PE. Analysts think it should go up 26% over the 1 year. This is up 24, but look at this volatility. Whew. This is like you go to the amusement park. This is a roller coaster. This is the roller coaster that, makes your stomach sink on the downhills. And is this an opportunity? Maybe. Let's take a look at the valuation. Let's take a look at the valuation of Oddity as well. So let's go deep with HIMS first, and then we're going to come back to Oddity and see if one's better than the other, or if they're both similar. 10 analysts cover this stock. One analyst is pretty low, but there's some analysts that are really high. Okay. So we're operating in the year that ends December 31st, 2025. Their profitability came down a little bit, but their growth has been fantastic. Now, their growth is slowing. We're growing from 62% growth down to 19% growth, which is good. 19.5 is also good. It's just not incredible. And that big sell-off may have been that. Let's take a look at the quarterly. So the quarter that just closed and that they reported is likely this one. And their growth was 49%. They're guiding that they're going to grow about 31%. You see the slowdown here. Okay. They're making a little bit of money, but not a lot. Okay. So this is what's ailing the stock, is this slowdown in growth. Now, this is a stock that if you monitor it very closely, you could probably take advantage of good news or bad news. If you see that the growth is actually going to be better, and I don't know what kind of signals you can study, but I know that HIMS is pretty vocal about some of their web traffic, then that would be an advantage. If you're seeing that they're actually going to grow better than what's being expected, this stock's really going to fly up. Or the opposite, if you know what, the market has it right, these analysts have it right, they're going to slow down. Okay, then we can set our expectations appropriately, accurately to what's being forecasted. All right. So let's get out of the quarterly, get back to the annual. So they have earnings per share is going to be 66 cents in 2026. All right. Now, one thing I want to look at is their free cash flow and see how that cash flow has been doing. Hopefully, they're growing their free cash flow. And it looks like their cash flow has kind of gone up and come down. It is a good cash flow number. 133.9 of free cash flow is very good. And if last time I looked at HIMS, their balance sheet was in good shape. Let's see if it's still the case. Cash of 629, debt of 1,120,000,000. That's good. That's fine. I think it is. Debt to EBITDA. What's going on here? All right. We're going to take a close look because debt to EBITDA is way above 3. What's the deal here? That is a surprise. So let's take a look at their actual investor relations page. I want to look at their balance sheet and see if maybe stock analysis is classifying some things that I wouldn't consider debt. So here's the 10Q, exactly what I need. And we are in the right section here. So it looks like the cash was correct, a little over 600. And then liabilities. Yeah, they do have close to $1 billion of notes. So their debt's $971 million. And their cash is 346 plus 283. All right. So their EBITDA, why is their EBITDA debt to EBITDA so wonky? So has their profit declined compared to last year? Let's take a look. This is probably tiny for you guys. It is. Let me make it bigger. All right. So we got 24 and 25 here. I'm looking at the 9 month. Okay. And revenue growth has been good, going from 803 million up to almost 1.3 billion dollars of revenue. Good. They do spend quite a bit on marketing. They're spending money on sites when somebody searches something like, hey, I'd like to lose weight. And then they probably will advertise to that person. Okay. So their expenses are quite high. I know that they continue to grow. So this number is continuing to be high because they want to grow. That makes sense. Okay. So their profitability isn't very good, and that's why their debt to EBITDA is really high. Okay, so debt to EBITDA is a concern. I will put that out there that I wasn't expecting debt to EBITDA to be a problem, but we're dealing with a problem now. All right, so let's get into evaluation of HIMSS. Okay, so this number is going to change because of their debt to EBITDA. I think it's pretty expensive, and the free cash flow is actually lower than $200 million. So it was $133 million, growing by 25%. That might be a little too aggressive. I'll keep the initial year at 25%. That's fine. And then their cash was 346 plus 283. And their debt 971. Shares outstanding. Let me update that number. Well, I think that's correct. Okay. So earnings per share. What was that earnings per share number? So in 2026, 66 cents. Yeah, this all looks good. P ratio beginning to, my enthusiasm for the company is kind of going down because of that debt level. I guess net debt isn't a big deal. No, the debt's fine. Because I forgot, the website is comparing debt to EBITDA based on all of debt, but they have a lot of cash on the balance sheet. Once you net out the cash, they only have 350, right? If you take the cash and kind of net it against the debt, we're only dealing with like $350 million of debt. So I think I'm okay with that. All right, P ratio 25. They're growing well, but they're not going to set any records according to the forecast. They are growing their profits well, but the stock price is it's too expensive. The HIM stock is worth $26 per share, and it's priced at 35. If they can grow fast, we got something. But they're not going to grow fast going forward. They're going to grow well, but they're not going to be incredible. They're not going to be at 60% growth. They're going to be at teens, 18, 19. And then it's supposed to drop to 3% in 2028. So they'd be a little expensive, a little bit on the expensive side. Let's take a look at Oddity. Oddity, I'll update this, but they're discounted nicely. Let's take a look at their the review here on stock analysis. Now, their stock is under pressure. It's down 9.8% for a couple months. Boy, this thing was just flying up, going from $40 a share up above $70 a share. But really, over the last few months, this stock's really come down. So what's going on with their performance? So the revenue continues to grow. So the revenue growth I don't see is a big giant problem. Okay. And let's take a look at their cash flow and profitability. They have very good gross margins. Their profit margins are consistent. They're good. They're good. For a small business, those are good. And then their free cash flow margin looks okay. It's a little bit of concern that it's, kind of tracking down, that it's slowing down, but it's still good. They're still generating cash flow. Okay, so we've got 11 analysts covering them. The analysts think there's a huge discount available on these guys. This is a small cap, and sometimes these small caps, they kind of don't get the attention of Wall Street. The revenue, $816 million, and growing nicely. Good growth. This looks good. And earnings per share is going to expand nicely, bringing down their PE ratio to a very sensible amount. So this stock's discounted. It's a real good one. But when's the market going to pay attention to these guys, right? So where are they headquartered? So these guys are headquartered in Tel Aviv. So how can they get noticed? How can they begin to get more investors to pay attention to them? That's the question I cannot answer. But that's what's missing here. They have very good fundamentals. It's a, what are their main markets? So let me ask Gemini. So are they selling in Europe so the United States generated 85% of the revenue, internationally 15%. Okay. So they're selling here in the US. So I'm not very familiar with oddity, but it looks like these small caps, this is what concerns me about them to some extent, is the market could ignore these. And it's kind of a guess as to when the market's going to pay attention to them. And I think it's a very discounted stock, no doubt about it. I think it's growing really well. Oddity versus HIMS. Oddity looks like a better investment, way better investment. And how would I play this one? I would wait for it to start to rally. And once it begins to rally and establishes that, hey, investors are paying attention, at that point I would buy. That's how I would play it. But to answer your question, Oddity looks good. HIMS looks like it's way overpriced. And that's the compare between Oddity and HIMS. All right. So good to see you, Mark. Thanks for coming back. Looks like Benton is online. How you doing, Benton? And you want to take a look at XENE and Prax. These are stocks I've never looked at. So this is like small cap Saturday. Perfect. All right. Noted. And Neo. So I remember Neo was kind of a popular stock 3, 4 years ago, maybe five. It was like, if we're talking about the same Neo, shadow guy. Stocks, and stocks. Good to see you, shadow guy. Hope you're having a nice weekend. We're moving toward the holidays. My family, we celebrate Christmas, so we're looking forward to it. Really looking forward to seeing people I see over Christmas and then the New Year and whatever you celebrate. I hope you have a great time and kind of fill your cup of goodness of spending time with people you care about. Just kind of resetting, and then come January 2nd, let's go outperform that market. Let's go do it again. Speaking for myself, I outperformed the market this year. I want to outperform it next year. But I'm going to try to have a good time for the remainder of 2025. And come January 2nd, it's all business. Let's go outperform that market. Here's one not to buy. LAZR. They filed Chapter 11. LAZR. Let's take a peek. See what happened there. Maybe we could see maybe some characteristics that we don't want to buy when we see stuff like that. Because I look at the balance sheet for a reason. And the more debt a company carries, yeah. Kurt, good to see you. Hope you're doing well. I really like coin right now. I would love to talk about Coinbase. Dave, I always like Dave, but man, the market just doesn't. The market kind of doesn't do what I think it should do at times or what I expect it's going to do. But I got a lot to say about coin. Increase 98.96. Good to see you on the stream. If I'd love to look at CRMN. If you want to buy a $5 super chat, I will put it on the list. Great to have you, sir. All right, let's keep rolling here. You guys showed up with a nice list of stocks to go over. We're going to look at XENE. So Xenon Pharma, $3.4 billion market cap, 7.5 million of revenue. So this is a expensive stock because you're buying the stock for many times revenue. Analysts think there is a discount. 1 year, up 12%. 5 year, up 234%. So Xenon Pharmaceuticals, a neuroscience-focused biopharmaceutical company, engages in the discovery, development, delivery of therapeutics to treat patients with neurological and psychiatric disorders in Canada. Its product candidates include as something. Okay. So biotech. And it's really done well over the 5 year. The 1 year, it's kind of not gone up, at the rate that it was going up before. Now, what is interesting is they're not a revenue producing company. Huh. Okay, so let me see if I could get Gemini's help. So I want to know, what kind of patents does this company have? So they hold numerous patents. So where's the revenue? I can get that here. Let's take a look at their revenue forecast. Where is the revenue? Okay, so we're moving from no revenue to some revenue next year, but you're waiting a full year and a quarter before we start seeing revenue. Then we're going to see the revenue jump up. You're supposed to grow very quickly once they get to market. There is a good number of analysts covering it. Yeah, and I can't put a valuation on this because I'd be dealing with the data from 2026, and it would just basically mean that the valuation would be really low. So this one here is, you'll need to make decisions on, okay, I'm gonna have to build a very unique forecast of how they're gonna get to this revenue stream, and will they be worth the investment today? It looks like the market is a little nervous about it just based on where the stock is going, or has been, I should say, for the last, year. You see that the market was a little nervous and then nervous again. It's up okay. But man, if a competitor comes into the space, or if they can't have any kind of hiccup on going into the commercial stage of these drugs, this thing's going to be under pressure. It's going to make some investors lose some money. It's not my investment that I would make because I'm not seeing enough to be completely comfortable in putting money down. And I can buy into biotechs right now that are pretty damn solid. I just finished a video on the best growth stocks for 2026. There were two biotechs in there. One of them, I'm not going to tell you which one it is. Watch the video and you'll see which one it is. It looks great. It looks way better than this. So remember that we're buying in a market of stocks. We're not just dealing with one stock that's available for biotechs. There's 50. Pick the best one. Pick the one that you think is going to do the best. I can't predict what these guys are going to do. I'm not just seeing enough evidence. So for me, XENE, too risky. It would be a pass for me. Let's move over to Prax. Praxis Precision Medicines, a clinical stage biopharmaceutical company, engages in the development of therapies for central nervous system disorders characterized by neuronal excitation and inhibition imbalance. The company's platforms include Cerebrum, a small molecule platform for CNS small molecule therapies to develop orally available precision therapies. Okay, biotech. Okay. All right. So these guys over the last year, wow, look at that. 289, 5 year. Wow, they were worth a lot. They came down, and last year there was probably some good news. And let's take a look at their forecast. 14 analysts are covering it. They think there's a discount, even after the stock went up as much as it did. Now, they have very little revenue, and their revenue streams are going to come in 2027, 2028. So we're back to where we were with the other company. These projections look really interesting, but is it worth the current stock price? I don't know. And it's not like the stock is kind of sold off and investors aren't bidding it up. No, they're bidding it up. So are they seeing like enough value there to invest? Maybe, but I would just be kind of following the crowd on this one. I just can't put a forecast together. They don't make enough money. They don't make any money right now. So these are just kind of stocks that I can't really get my head around because they don't have fundamentals in the next 18 months that I could work with. So thanks for asking about this. Sorry that I can't do much there. Let's take a look at Neo. This is not the Neo that I was thinking of. So these guys operate a network of cancer-focused testing laboratories in the United States and United Kingdom. It operates through two segments: clinical services and advanced diagnostics. Okay. So this stock is been sold off for the last year. It's been sold off for the last 5 years. $1.5 billion market cap, revenues of 709 million, forward P of 79. So the growth of the business, we're in this year here, they're going to grow by 10% next year, 9, 10, 8, and then a big bump here. The earnings per share is going to expand quite a bit starting next year, 2026, and then continue to go up, bringing down their PE ratio. Okay. So they have a little bit of debt, 246 million. They have negative cash. Debt to EBITDA doesn't look good because their EBITDA is probably like really small. So this one here doesn't have the fundamentals. So the cash flow, negative cash flow, I'm not going to be able to value the company. And their debt to EBITDA is because they don't. Let's take a look at their gross margins. So revenue growth, 10%. So you see how the gross margin number is 43. If you look at some of those biotechs, they'd be around 80, and they just generate more earnings before interest, taxes, depreciation, amortization, EBITDA. These guys don't. So it's very hard for them to pay off debt. It's very hard for them to produce profit. So this one here is like, I will not touch this company. This one is not, I don't think will ever be a stock that I'd probably say, I'd like to buy it, unless they were kind of giving it away. But stock prices go closer to zero for a reason. And this one did want to go close to zero, $4.84. Man, I am not. Again, I looked at some biotechs earlier today. There's some fantastic ones out there. So my opinions on these three, not the best opinions you've heard, but there's some good ones out there. So Mark, you want to look at docs. Put it on the list. So Shadow Guy. So you're looking at on the Oslo Exchange, DNO. All right. And then Mark, Duke Energy. I think it's DUK. All right. All right. Shadow Guy wanted to look at a business, or he mentioned a business that went bankrupt. Let's take a look at that. All right. So Luminar Technologies, an automotive technology company, provides sensor technology software for passenger cars and commercial trucks in North America, the Asia Pacific, Europe, Middle East. It operates two segments: autonomy solutions and advanced technology services. All right. How Luminar's doomed Volvo deal helped drag the company into bankruptcy. Oof. Well, that's not good. They filed for bankruptcy. All right. Let's go look at the balance sheet. What are these guys doing with their balance sheet? So they have $449 million of debt. They have some cash. All right. Debt to EBITDA is not available because they're losing money. So we see their top line revenue was growing well. The 2024 year, they only grew a little bit. And they kind of hit a plateau. They actually contracted a bit. Cost of revenue is really high. They actually have negative gross margins. That's why they went bankrupt. So they're basically putting more money into the product before it leaves, before they put it in the box and ship it to the customer. It costs more than the revenue that they're going to charge that customer. Well, you can't stay in business for a long time if that's going to be the case. So that's where these guys were doomed. I look at gross margins for a reason. It shows you how much money they could potentially make, or how tight the margins are going to be. And see, these are negative gross margins. I would have never touched this business. These are just really, really ugly numbers. Whew. Well, we'll see what happens there. I hope all their employees find good jobs. All right, let's talk about Coinbase. So, Coinbase was one of the original crypto exchanges. They're the first ones to be publicly traded. Now, here's what I believe is their culture, or kind of like their reputation. They have a very strong reputation. Here's why I could say that. They were the first ones to do an IPO, to be legitimate. That did mean a lot to me. It takes a lot to be public, and for them to be in a very innovative, brand new business and be subjected to earnings calls and issuing out financials and so forth, just showed that the founders had a real intent to be legitimate, for everybody to take them as legitimate players. Second, when we study what Coinbase has been doing for the last 5 years, especially, is they've been meeting with leadership in the U.S. to have kind of legal definitions around crypto. And the current administration's really on board with crypto. And the previous administration was really anti-crypto. And if you recall, like, I forgot the guy's name, but he was, I think he was the DOJ. Yeah, he was like one of the DOJ leads. I think there was kind of a joke that he was trying to protect investors, and he wanted to protect investors by keeping them from buying into crypto. And dude, that's not your job. Your job is to make these companies communicate accurately, and then leave the investing up to the investor, because it's the same guys that drove the car off a cliff back in the big subprime market meltdown. Those are the same guys. So You make sure that everybody's, that Coinbase and anybody else who wants to sell crypto or cryptocurrencies themselves, so long as everything's being communicated to the investor accurately, they should just allow it. Back to Coinbase. Coinbase really formed relationships on both sides of the aisle and really worked with leaders to have policy around crypto. And they put a big investment of their time and focus. And the last administration made it so darn hard that the new administration, it seems like it's super easy because it was so damn hard before. And now they're going to get into, Coinbase is going to get into the prediction markets, which has complete legal footing. And some states tried to block it, but Kalshi sued them all and won and said, no, you can't block it. We're using the same legal vehicle as, stock option trading uses. And if you're going to stop us, you're going to stop that huge machine that is options trading, and they can't do that. So Kalshi kind of did a lot of the hard work. So now Coinbase is partnered with Kalshi. Kalshi is also partnered with Robinhood, and they're going to provide prediction markets. Investors will be able to buy contracts on Coinbase. They're really being, the platform is Kalshi for it. Coinbase has a terrific institutional services business where they will do the treasury services of crypto for some of the most recognized names, the big firms that are more old school that want to offer ETFs and so forth that have crypto exposure. So all those things are really good. The company tends to trade where Bitcoin is trading. And right now it's over the 1 year, it's down. Okay. And it's all about buying stocks at the right time. It's not necessarily just buy a stock, fall in love with a company and just buy it no matter what. That's not good. You want to buy it here, which is when I bought. You want to wait for the conditions to be really, really better for you. And then you can see your stock go up. Even though there's a recent pullback in the stock, Coinbase is a winner in my portfolio because if you buy at the right times, you will see your investment go up in value quite well. I think Coinbase is going to go higher over the next 5 years. I think their vision of crypto and new markets and new businesses, they have it. And a lot of other companies don't. And these guys are going to continue to grow and be an important part of the whole financial economy. When I value Coinbase, and maybe I could update my valuation, it did not have prediction markets in it. But let's take a look where I have Coinbase. So right now I have an 8% discount on Coinbase, but now I'm, quite more enthusiastic, bullish. My sentiment on Coinbase has gone up because they're going to do prediction markets. Prediction markets revenues have been really good for Robinhood. I'm also a Robinhood stockholder, and I think the same impact is going to be there for Coinbase. So I think the numbers could look a little better. Let's take a look at their forecast, and then I'll update my valuation here. So we got 27 analysts. They think heavy discount on Coinbase. Okay. We are in this year. They've seen growth. They're going to see growth next year and the year that follows. And we might have some flat years and then growth. So not any like record-breaking growth is being forecasted. These are a lot of analysts that are putting in their 2 cents here. That's still pretty good growth. But I would think that they can do better than that. All right. So that's their forecast there. See, the revenue growth has been fantastic. So the forecast that they're putting down isn't all that great. I think it's going to be better than those numbers. Free cash flows there, even though they have been burning cash because they're putting a lot of money into their operations. So there are a lot of capex into their data center, not to build AI and stuff, but they have data centers to run their platforms. Gross margins. Look how big that number is. 84% gross margins. Wow. Profit margins 43. Now we're talking. Now we're talking. Some serious profitability. All right. So let me open up Coinbase on one screen and then we will update the numbers real time. Okay. So the way that I calculate it is they have gains on their Bitcoin, and it's not included in their free cash flow because it's generally accepted accounting principles. So that's how I get to this number here. Cash, debt. That looks good. How about? All right. So earnings per share will be $6.90 next year. Yeah, so Coinbase is discounted by 8%. I think I'm going to remain kind of optimistic about the business, but probably give them a quarter or two to see how the fundamentals change. So I'm not going to be buying shares left and right. I'm just going to hold the shares that I own. I still feel like, hey, this thing's worth holding for a while, like years. So long as they keep, creating more value for their business. And the most recent news that they're going to have prediction markets as part of Coinbase, that's evidence that, yeah, they keep making the company better, more valuable. So I'm good with the company. Valuation doesn't look superb. If you look at Robinhood, that looks like superb because they know how to monetize their business and drive free cash flow. So that's Coinbase. You want to look at Dave. Dave is in financial services. It's been kind of going sideways. These small caps, okay, they may look terrific on paper and the market just ignores them. So 1 month up nicely. But you see that, if you look at since May 2025 to now, not a lot of appreciation. So let's take a look at the numbers. I'm fairly sure this thing's going to be highly discounted, but I think like the comments I made on oddity earlier, man, I need the market to clearly show me that it's interested in Dave's software or Dave stock, because this stock could just continue to just kind of go sideways, maybe even sell off because it's being ignored by the market. P/E ratio for 2026, 19.34. Okay. They have good growth. The growth is there. Terrific growth. If you look at the quarterly, man, awesome growth. Why isn't the market buying this stock? Looks good. Free cash flow looks fantastic. Gross margins look good. Profits look good. Stock market. When are you going to start buying Dave? What is the deal? What do you have against Dave? It's discounted by 56% for Pete's sake. I don't know. But this one is one of those watch stocks that, hey, once it starts to work, it could work for a while. So for me, I kind of I need to watch these, and if it starts to establish a rally, okay, I'm game. And in finance or financials, excuse me, Dave and PayPal and others, they just don't catch a lot of attention. And even Visa for a while was just going sideways. So I don't know what it is. Maybe it'll change soon, but Dave's highly discounted. Fundamentals look terrific. Um, but when will the market pay attention? I don't know. So this year, growing really well, going into the teens. 9 analysts are covering the stock. That's where we're at with Dave. I guess the fast growth, if they go from fast growth to just slow growth or slower growth, then the market was kind of right to rally the stock and then slow down because it's like, whoa, they're not going to be growing at 50, 60% for many more years. Then the market was like, oh, okay, we got to slow the rate of appreciation. So it's going to consolidate fundamentals. We'll see if they can grow faster and outperform and surprise the market to the upside. Then the stock could work. They're going to announce earnings beginning of February. And maybe at that point would be a good point to revisit Dave. So those are my comments on Dave. Good to see you, Kurt. All right. So yep, Benton. Those biotech stocks, I mean, they may have drugs that look really, really neat, but I mean, there's some stocks out there that are proven, like United Therapeutics. Growing, doing well. The growth isn't as like amazing as the stock we were looking at, but the growth has been good. Trailing 12 months looks good, and they make a lot of money. And actually, they had a breakthrough. Free cash flow looks fantastic. And United Therapeutics had a breakthrough where they had positive trials results, and they're going to get one more commercial drug to market. So that's going to help them grow. And they have these big bets out there. So this is more my style. I got real fundamentals. I got a real investment. I can make money. I see their fundamentals. I think other investors are paying attention, and they have those big bets. As their big bets begin to become reality, great. Stock will continue to work. All right, so we're going to look at Duke Energy and then Mark. So oil and gas, it's all about that per barrel price. If the price of oil goes up, so will stocks. It's that simple. And I don't know if oil is going to go up very much. Right now it's up about 1%. But I don't know how much further it's going to go up. If it goes up, oil stocks go up. All right, so that handles that question. I think Mark want to look at docs. What is docs? Doximity. So Doximity operates as a digital platform for medical professionals. Its platform provides its members with digital tools built for medicine that enables its members to collaborate with colleagues, stay up to date with the latest medical news and research, manage their careers. Okay. So focused on the health industry, which is a big economy, providing software, providing this type of platform, probably giving doctors the ability to talk to patients using a nice app. This is becoming more popular. Totally get it. I've taken a couple of doctor's appointments in the comfort of my home. Totally. And it's cool because there was one doctor, I met him in person, great guy. And then we had our follow ups. And he said, "Do you mind if we do Zoom?" And I'm like, "Yeah, don't mind at all. Save me the drive down to your office." And he went over some lab results and went over it, had my questions, and we're done. It was far better for him, far better for me. I'm good with that. Year to date, under pressure. 5 year for a while, it was doing nicely. Now, a lot of healthcare stocks have been kind of stuck in the mud. Some of the news coming out of government is a little mixed. There's been some pushback on the subsidies for health insurance plans to individuals, that kind of thing. Um, this one here is an $8.22 billion market cap company, revenue 621, forward P of 27, big discount according to the analyst. When we look at the growth of the company, the growth has been good. Hasn't been any like record breaking fantastic growth rate. It's been good. This is kind of a smaller company, so growth rate of 20% is good. The business has very good margins, 90% gross margins. Beautiful. Profit margins of 40%. I would also like to say beautiful. And free cash flow 51. These are fantastic numbers. Okay. We all want businesses like this. We don't want like super tight, barely making money businesses. We want businesses that are making a lot of money like this. So these guys are looking good. What's their forecast look like? So we're in the year that's going to end March 31st, 2026. They're growing at 15%. And I think they were overachieving on that growth rate. Then they're going to go into this slow growth. Okay. P ratio is coming down. So they're very profitable, but they're not growing really fast. The other reality is Doximity is selling into one general sector, healthcare. It's not like they can take their solution and say, "Hey, let's sell this to other industries like automotive. Let's sell it to automotive dealerships." No, that's not going to work. It's just for doctors. That's it. It's the only target market you got. So that is a smaller addressable market than maybe a software industry, a software company that sells to many different industries. So that's one thing to be aware of, is their addressable market would have limitations. All right. So having said that, let's see if we've got a valuation on Docs. And back to the comment I made on biotech, right? Docs is selling into healthcare. It's a software company. It's discounted by 25%. Well, right now, I could show you at least 10 software companies that are discounted better and have already begun to rally. So having said that, Docs would be a total pass for me. I'll focus on some of the other software stocks that are really beginning to move, and I'll put my money there. So Docs is, that's what I'm seeing with Docs. If you want an idea around software, this is a small cap. So let me think about what would be all the ones that I'm currently buying into are doing fantastic, but are bigger. But what the heck? Let's just go to Adobe. Adobe's highly discounted. And think about this: is Docs is supposed to start growing at 10%. Adobe is growing at 10%, but they're huge compared to Doximity. So this is a big company. It sells across many different industries, growing at 10% plus. They also have 90% gross margins. They also have super free cash flow. They're really discounted and the stock's beginning to work. The conviction I have on Adobe is really high because they're a big business. I really feel like, hey, the market's now paying attention to Adobe. And I think Adobe could be one of my best performers for 2026. And there's probably 10 other software stocks that I could talk about. Intuit, growing better than 10%, growing really well. That stock was discounted. It's beginning to rally. I'd rather buy Intuit, rather buy Salesforce, which I'm investors in all those companies. So there's some terrific opportunity in software, which is what I think Docs is doing within the medical industry. So, Shadow Guy wanted to look at Oslo DNO. So DNO engages in the exploration, development, production of oil and gas assets in the Middle East, North Sea, West Africa. So they have fields in Kurdistan, West Africa. Wow, up 43%. Wow, impressive. This looks really good. The return, like the appreciation. 10% dividend. Holy smokes. This one's good looking stock, huh? You make a lot of money, your capital goes up in value, and they send you 10% dividend. Wow, that looks great. Market cap 14.6 billion, revenue 11.68. Okay. So Norway has a lot of oil reserves, and they know what they're doing when it comes to oil. When we go annual, the growth rate hasn't been there. Interesting. Is the most recent. Wow, look at that. So did they acquire like some new assets? They're beginning to grow real fast. Market really likes what they're seeing there. This is a fantastic find. Hopefully, Shadow Guy, you already own this stock and you're making lots of money. Free cash flows there. This stock's worth at least 10 billion. Could be worth 20 billion. Yeah, they're priced fairly now. I mean, the news is out. And if oil prices rise, this one will go up. If oil prices contract, it'll go down. Now, these guys will probably they probably acquired some assets from somebody. So they're going into deeper waters of Norway, and maybe they're striking oil out there. Well, they're doing something right and growing. Fantastic find. Good one. And if they keep growing that top line, this is like they're going to keep getting more valuable. I would just understand where's this growth coming from. Was it like organic? They're pumping more volume because they were able to drill offshore in deeper water, and that was successful. So yeah, the stock rally makes total sense. If they keep doing that, it'll continue to go higher. So that is DNO. Duke Energy. So Duke Energy is a utility, not a big utility investor. These guys over the 5-year up 28%, over the 1 year up 9%. The dividend, 3.69% dividend. So financials, let's see here. So they're growing some. That looks good. So just consistent growth. Good to see the growth. 5% growth. So my apprehension with utilities is they just don't drive free cash flow. They spend a lot of money maintaining the energy producing, you know, uh, assets they have, the big complex of power producing plants, and they have to put a lot of money back into them. So it's like, well, what money's left for the stockholders? Not much. That's why they pay a big dividend. Profit margins are low. Now, the market has been bidding up utilities, especially utilities that are non-regulated. They're able to sell their power more freely, and those stocks have really flourished. It's not something that I'm invested a whole lot because the fundamentals. I usually stocks like these are not the kind of stocks I invest in. The market's bidding this one up because it's the whole big picture is we need more power. There's just not a lot of money to be had here. They trade with low PEs, but for a reason. They just don't generate cash flow. And I think, will continue to be what I think is an undesirable asset because they don't have very good valuations. I think they get investors in by offering good dividends, but I just don't need a dividend. I need the stock to go up. Every 5 years, I want my stock to double in value. And I'll handle the selling of stocks should I need any money. So that's Duke Energy. I can't give you a valuation because it has negative cash. The forecast on earnings per share looks okay. You see, the market's not even totally locked in on this one, totally confident. So CSJ, one of our newest members, good to see you. Thanks for joining. Next Era Energy. Let's take a look at that. Next Era Energy. And I think you signed up. If you could get me your details, I'd appreciate it. I'm gonna put my email address on the chat. If you could email me so I can get you all your perks, that'd be great. And then you'll be all set up. Thank you so much for signing up. And there is my email address. If you want to email me, that'd be great. And just provide like your YouTube name. Obviously, your email address will be on the email. And then I'll get you signed up, get you connected to the Discord, give you access to the member calls, give you access to the folder of shared assets and the repository evaluations, access to the valuation model, and get you all set up. In the meantime, I will cover NextEra. Looks like Shadow Guy. Whoa, my man Peter is on. How you doing, Peter? Good to see you. Let's take a look at Vertiv. Man, this one here, Vertiv has been riding the data center wave, making lots of money. Let's see how the stock's doing. I've been a little skeptical of the stock, but it's been proving me wrong and any other skeptics out there. But we'll take a look at it, Peter. Good to see you. Shadow Guy. Definitely paying the risk premium for coin. Yeah. Yeah, I think it's because, crypto's down. I think Bitcoin We look at Bitcoin, it was really flying high and it's really settled down. So I think Coinbase is following this pattern. Um, Bitcoin was at $124 a coin. Whew. Now it's at 88. So that haircut, it Coinbase followed this thing. So that's what's going on there. Cool. Thanks, Ricardo. Good to have you. All right. So let's take a look at NextEra Energy. Okay. So these guys, so NextEra Energy, through its subs, generates, transmits, distributes, and sells electric power to retail and wholesale customers in North America. The company generates electricity through wind, solar, nuclear, natural gas, and other clean energy. It also develops, constructs, operates long term contract assets that consist of clean energy solutions, batteries. Okay. So NextEra. Okay. Big market cap, 165 billion. Revenue of 26 billion. P ratio of 21 for 2026. It's up 13%. Wow, I would have guessed this one would just be going up and to the right, like just cranking up. But look at that. It's just up a little bit. All right, let's keep looking. Dividend of 2.85%. Looking at their revenue growth, they had good growth in 22, 23, had a setback in 24. Revenue did contract. Looking at the quarterly, they are moving along the right direction. The growth has existed in 3 quarters in a row. Okay. Trailing 12 months, revenue is flat. Man, look at this negative cash flow. What is that? Why are they burning so much cash? All right, we'll take a look at their cash flow statement. I'm curious. So, profit margin, gross margin is 24%. That looks really good. Why do they have such negative cash flow? All right, so let's take a look at their actual okay. So here's their most recent financial statement. So that's weird. Oh, it's in a spreadsheet. Okay. Well, I don't want to see a spreadsheet. All right. So Next Energy delivers strong third quarter. So FPL. Collaboration with Google. to do some nuclear energy. So I'm reading, guys. Sorry for the silence. Okay, so it looks like they have two businesses and then other, and then consolidated. So they made money. Here's their profit. This is for 9 months, profitable. So balance sheet, they have close to 2.4 billion of cash. Whoa, they got a lot of debt. So 84, no, it's 84 million. Okay, not too bad. So this is in millions. So that is 84 billion in debt. Okay. So here's cash flows. This is usually where I just don't like utilities, but let's go through this. So net income, you see they made money. Okay, good. Depreciation, this goes back. This is like you're depreciating, but it's not a cash item. So you have cash from operations of almost $10 billion. And then, so independent power and other investments. Nuclear fuel purchases. So this is CapEx on FPL. Okay. So they're growing quite a bit. I mean, they're trying to make themselves bigger. They have that partnership with Google. That's good. And making themselves bigger. So what I'm going to do is I'm going to look at kind of a longer like viewpoint of cash flow. Let's look at it annually here, right? Kind of say, okay, for the last 10 years, what has the average been? Have these guys just been a cash burner forever? Or have they, before this whole AI craze started and they started pumping money into the business, did these guys have better cash flow? So let's see if I can answer that question. All right. So what am I looking at here? So this is cash flow. And so here's my operating cash flow here. And 2017, 6.4, 6.5. So that's been growing really well. So that looks good. CapEx, see, it's always been higher. Huh. So I'm going to ask Gemini. So, what are the best valuation methods for utility stocks? So, discounted dividend discount model, discounted cash flow, which is going to end up being a negative number, residual income model. All right. So, I had a thought that maybe what I could do, and so looking at the 9 months, this is 9 months, not even 12 months. So if I were to annualize this, I'm going to get to like 1.13.5 billion in operating cash flow. And the depreciation that they have against their business is 5 billion. So if I annualize that number, I'm going to get to about 6.3 billion. So overall, if I net these two numbers, they are adding more enterprise value in this capex, meaning they're kind of putting assets into the business that are going to be worth a lot because they're generating electricity. So let's do um, a next era energy valuation. This one's going to be fully custom, but we're going to make it make sense. All right, so next era is not like any other business I have, but let's think on our feet here. Okay. So this is going to be, I'm going to call it adjusted free cash flow. And it's going to be cash from operations minus depreciation. And when I look at those numbers, and I'm looking at a screen you guys can't see, the trailing 12 months free cash flow is, and I'm looking at the wrong statement. The trailing 12 months cash from operations is 11. 11,967,000,000. And I'm going to decrement depreciation and amortization, which is 6,808,000,000. And I'm gonna add some growth to that, but let's just kind of take this thing one step at a time. All right, so these guys are growing top line revenue by at least 5%. Okay. And I mean, electricity demand is pretty insane, right? It's pretty it's pretty high. So all right, so we're growing that number. We're growing this number by 5%. So intrinsic value is 168 billion. Let's add cash, take away debt. So the cash balance is 2,309,000,000, and they do have some debt, and it was 84 billion. So we're not getting to the number. We're just falling short of it because of the debt. Okay. The market cap's 165. The adjusted free cash flow gets 168, but I decrement debt, which is appropriate in my book, because you're going to have to pay back the debt. Somebody's going to have to pay it back. The earnings per share for 2026 is $4.02. P at 24 is fine because it's in a popular industry. And top line growth is supposed to grow by a better measure, like 9%. So that's good. So NextEra is not priced to reward investors through value. I think it's really interesting because we need power. The data centers need power. Why isn't this stock like flying off the charts? We're going to look at Vertiv in a minute, and you're going to see a stock that's flying off the charts because the market just thinks, man, the data center is going to grow forever. And this one here has not been flourishing. It's up just a little bit. Huh. Yep. So I'm getting to I wouldn't invest in this stock. I would pass. It's just the numbers that the market's not buying it. The numbers don't look good. It's just not a good investment for me. So thanks for asking. That's as far as we can get on this one. It's pass. It's not going to make us wealthy. It's just going to sit around. It's going to consume our capital and just kind of not go anywhere. Well, we don't want that. We want it to go higher. We want to buy a stock. We want to see our value go higher. So that's where I'm getting with NextEra. I'm going to pass. Good to have you, Ricardo. Please send me your email. Thanks for asking about NextEra. All right. Peter asked about Vertiv. So Vertiv's doing well this year. It's been just flying high. And these guys design, manufacture services critical to digital infrastructure technologies. So they do AC, DC power management products, switchgear, bus bar products, thermal management, cooling. And when we look at their product, I look at it and I'm like, yeah, this is an industrial stock. And when, it's impressive they're in the data center and they put a robot here too. But once we go to the products, right, you're like uninterruptible power supplies, that's a commodity. Switch gear, switchboard commodity. In room cooling, right? Rack cooling. Let's take a look at that. So when you talk about rack cooling, you're talking about racks. This is a commodity. It's not like, whoa, they're the only ones that can do this. No, they have a good rack system. Got it. But it's not like they have a proprietary patent and they're the only ones that can do it. No, that's not the case. They're a pretty popular company. They're growing. Let's take a look at their margins. So their growth is good, 28.7, because there's been big growth in data center. And then this is where, so gross margins, 35%. And that's where I kind of point to. They're in a commodity business. They're not in a proprietary technology business like NVIDIA or other very valuable businesses. Once things slow down, these guys are going to really feel it because their margins are tight. And they're enjoying a good growth period. Their profitability is nice and high. But once things get back to normal, it's going to be a 6% profit business. That's not all that attractive. And their stock's probably going to, get crushed, in my opinion. Margins aren't there. The free cash flow, it's not great because of the margins. Let's take a look at it. So free cash flow it's been climbing, but it's been somewhat flat. Okay. And the free cash flow margin has been decent, 14%. They're probably getting very good prices because there's excess demand right now. But again, when things cool down, things slow down, it's going to get ugly. And for now, they're probably just loving the high stock price as a company. I think anybody who invests in this space, put your running shoes on because you're going to have to run out of the stock when things slow down in the data center. I think I have a valuation on Vertiv. Yeah, and I think it's priced too high. No big surprise. And this is giving them very, good growth rates. I think it's priced too high. If it slows down, which it will, data center will slow down. This stock's going to get crushed. This is one of the first ones that gets crushed. NVIDIA can hold their stock price because they have a lot there. They have very good margins. They can sell to other places like China and other places. Vertiv, I think, is going to be one of the first canaries in the gold mine that'll get crushed. But that's my opinion, only mine. It's my research. Hopefully you found it interesting. Great to see you, Peter. All right, so catch up on comments here. DNO has oil fields in Iraq, Africa. That's right. Yeah. That's a good plan there, Shadow Guy. Juicy, man. Juicy brings up some really good stocks. Here's another example. I think he was early on that data center company, Nebius. He was early on Nebius. Good for him. He said that was his number one stock. Good for him. Yeah, and energy demand is going through the roof. The ones that are making the killing is like GE, Vernova, GE, because they make the equipment, but their prices for that stock is super high. It's a tricky industry. One of the lessons that I think Warren Buffett and a lot of like wise investors have said is if you don't understand it, don't invest in it. And utilities, I don't quite understand why they spend so much money on CapEx. Why don't you just raise your rates, like double the price you charge for electricity and tell the customers, sorry, but it costs a lot of money to generate power. They don't. And it's like, all right, so, we're just going to have businesses that have to put so much money back into their businesses that they're not very profitable. The public likes that because they're like, hey, I want cheap power. But investors like me don't like it because I'm like, well, I want a great rate of return. I'm on the other side of that deal. All right. Good stuff. Man, I'm seeing a lot of you guys on the weekends. Thanks for joining. Appreciate it. A lot of people are on the stream. Thanks for joining. Let's see where we're at with. Well, the markets are not open, so that's not going to give me anything. I'll just park it there. Clean up my screens a little bit. We've gone in a lot of different directions. All right. We ended on Vertiv. Sounds good. For you football fans out there, I am watching the Eagles play the Washington Commanders. And the Eagles have not been playing all that great. And right now they're playing from behind. They're trailing the Commanders. The Commanders have a lead, 10-7. And the Eagles got to win. If they don't, they're losing all momentum. So we'll see. See if they can pull it off. All right. So are there any other requests out there? Let me know. Let me double check to see I didn't miss anybody. So again, good to see you, Ricardo. Shadow Guy, great to see you. Peter, great seeing you. Mark, thank you for the questions. Good to see you. Benton, thanks for bringing your biotech ideas to the call. Kurt, good to see you. Thanks for asking about coin. And Dave. All right, looks like I'm caught up. Herdo, great to see you. All right, as mentioned, I'm going to be cranking out a best and worst growth stock video, and I'm taking the research, straight out of Stock Analysis. So look for that video to come out later today. I've done all the filming. I got to edit and then just crank it out to members first, and then maybe in 30 days it'll be released to the public. So take a look for that. And then Jesus, I'm glad to look at TSM. It's a stock that I actually own and follow. If you want to buy a $5 super chat, I'd be happy to do that. Or you can become a member and then you can request stocks. In fact, I'm putting the member information on the screen. If you want to take a look at the home screen of my YouTube channel, you can become a member very easily, and then you can request TSM. All right, so I'm kind of running out of material. Let's see if anybody else. Yeah, you're welcome, Shadow Guy. I'll be streaming again tomorrow, guys. Probably going to stream around 4 p.m. Eastern, 1 p.m. Pacific. If you want to join me then, that'd be great. If you want to watch football and talk stocks, I'm your guy. Yeah, I've looked at CRMD. We've looked at it a few times on streams. Looks like OB_R9075. It looked like an interesting stock. I think you want to focus on the forecast. Make sure that you understand how many years will they grow, because you don't want to be surprised and feel like you're buying a growth stock only to see it slow down. All right, go Chargers. Yeah, I root for the Chargers. I don't root for the Rams, even though the Rams are probably a better team this year. The Chargers, I think they'll make some noise, but I don't know if they're going to get through the AFC playoffs. We shall see. All right, guys. So I'm going to end the stream there. Thanks so much for joining me. And I appreciate you guys joining the stream and watching the videos I produce. Let me know if there's anything else you want me to bring up on live streams. And I'll be streaming quite a bit for the next couple weeks up until the new year. And hopefully I see you guys on the streams at those times. Everybody enjoy the rest of your Saturday. And I'll be back tomorrow. I'll post when I'm going to stream as soon as I can, and it'll be on the channel. Have a good night, everyone.